Hey everyone, pretty wacky week last week. We did get the retracements that we wanted to see on most of the assets and then some. While most of the market expected continued short buys, and we did too, we expected a bit more of that tempered rebalancing of price. We were able to get some good shorts, but there was a big clue halfway through the week that really let us know the bearish side wasn't going to continue too long, and now we'll probably have to wait for FOMC this week to see continued bearishness. I'll get into what that clue was later, but for now, we're going to analyze our usuals: the dollar, euro, pound, gold, silver, copper, soybean oil, crude oil, indices, and Bitcoin. So stay tuned, see what the clue was, and why we think it's going to turn midweek again this week. Okay, so on the dollar, weekly time frame here, we did have a nice rebalance of some of this bullish price action from last week, which is not entirely unexpected. We pushed up and we expected to see some retracement back into these fair value gaps, so we will look at those on a daily time frame here. Here on the daily time frame, right, we had this push up, and then we expected for this week actually a retracement, hopefully, not too far into this weekly gap down over here, so we've rebalanced that and pushed up through it. So we were hoping to see, a deep enough retracement to get a good entry long on the dollar, short euro, short pound, etc. And we wanted to see maybe the 75%, the upper quadrant of this gap actually traded to, and it almost did, right? So we did push down, we pushed back up, we pushed a little bit deeper here, almost to the top quadrant. So I actually expect this to get tapped next week early. I think we come not too deep here, but maybe right to that 75 and then up here. So our forecast here wasn't too far off. We thought we'd see a retracement, that we'd see oil come down, we'd see the euro pound indices have a bit of a breather after this big push up. So we did dig into that, and then we had a nice reaction. So we'll see that on a lot of the assets that we look at this week. Just a little cleaner look here on the 4-hour time frame. So, this was what happened last week. We basically came down right to where we drew that arrow. And we had a big reaction on Thursday with PPI and the news about possible peace deals again. I just think that the news is just playing everybody here. So I would expect to see some kind of dip once more to take last week's low before we're actually skyrocketing here. And it may be fast, it may be a little bit choppy on this way out, but every sign is still pointing to dollar higher. If we do break through this imbalance to the downside, then the narrative completely changes, but I really don't see that as coming to fruition. They're going to keep throwing these headlines at us that make everyone want to sell out of the dollar really fast, buy into risk-on assets, and I'm not buying it. So I'm thinking that they're just going to keep throwing those headlines at us that peace is coming or there's some deal in the works. Maybe there will be a deal that won't be very finite or very particular in coming to terms on how the ongoing conflict will actually resolve. So that could lead to some degradation in the dollar, some weakness to just take some of this liquidity. I do see a trend line here. So on a 4-hour basis, I would expect earlier in the week to get a drop and then a pump. There are both retail sales and FOMC rate announcement on Wednesday, New York time. So that could definitely be a catalyst, either if this manipulation has already happened, to really take the run higher, because I think there may be a rate hike priced in here, or to be priced in here with the new Fed chair, Warsh, coming in and seeing what's going to happen. Not that he gets to make any official decisions, it's a vote by the governors, but there is something to be said for his first press conference after meeting as chair. So, there's certainly reason to be cautious and patient. I do expect that this little trend line here will get blown out, and then we could see a move to the upside. Again, if this imbalance gets wrecked to the downside, we're pretty toast until back down here below this low, and then we got to adjust and see what happens. If we take a similar look at the euro, so again, we thought we'd pump up and then we'd start weakening again, and we did that, but then of course Thursday they had a surprise for us and popped through everybody, which on a narrative basis makes sense for the market to screw over as many people as it can. So I'm sure everyone thought, yeah, we saw this NFP Friday and we are going short. Everyone's going short. We waited for a patient entry. We got it right. This was right there. We nailed that entry, got a short in, held it a little bit. We could take some profit below these bodies here. And if you didn't, I'm sorry, but this wasn't completely unexpected. Just to wipe out people that think they're in, right? And then boom, we did have a flat double top here. We have another flat double top here. So that gives, certainly some reason for something like this to happen over the early part of the week. And then we could see this dump past Wednesday when the FOMC comes out. FOMC rate announcement could cause something like that. I saw this double top last week and I didn't like it. And I also, this one high here poking into this imbalance, there's something to be said for the possibility that we just get this massive wick through here, possibly all the way back up in here, that, somewhere on Wednesday, maybe, we get this massive wick up here, and then we can actually then see the continuation. So there then hopefully be a divergence between pound and euro. We did not want to see this wick get taken on the dollar, and on the pound had this manipulation right up here, and they have these flat highs and this weak high that I was talking about last week. It looked weak to me. It certainly felt strong last Friday, but we can see with the consolidation that's happened. So again, we had a nice short here on pound that we could have taken, but you probably would have gotten wicked out a couple times if not if you set your risk where we did. But again, we haven't necessarily reached a target down here for a longer term positional trade on a swing trade level. Taking profit at some reasonable lows in here would have made sense if you aren't just trying to hold for a longer term. There is this possibility with what's been going on that the news cycle decides to wipe everyone out here, maybe even get back up to here, right? That's in the super premium. So this wasn't out of the question last week, and now it's sort of, with what the price action has shown us, could be back in the question this week. So if this entire, looks like a distribution cycle. We had this wick up on Friday, taking out these highs, but it did not clear this high, and it didn't clear what I thought was a weak high. So, we haven't actually broken this low on the pound yet, and that could just be a nice setup for everyone to think they're getting short at the right time. FOMC announcement comes up, blasts everybody out, and then the downside actually hits. So while there was, a good chunk of news with NFP, really what's going with the market now is the war narrative, and some of this actually was quite expected based on what we were forecasting with crude oil. So if we look at crude oil again, some of these moves actually make complete sense, because if we're talking about a negative correlation with crude oil and some of these risk-on assets being foreign currencies, indices, and at this stage still gold and silver, which I expect to reset their inverse correlation with the indices to be a risk-off safe haven in a couple months, perhaps, maybe by the end of the year. We'll see how and if they start to diverge with the risk-on assets again. But when we look at crude oil, we can see why some of these bullish, nasty takedowns were actually more predictable than not. So actually, if we do look at crude oil right now, just to make that narrative make sense here, right? From 2 weeks ago, we expected a push up to close in this gap, and then we've marked this gap up from a while ago, 5-6 weeks ago, right? And on the continuous contract, it's almost there. On this July contract, we just started to dig into this imbalance. We did hit the 75% super discount, and we can see the bodies very nicely, respecting that 75 level for now, and we still haven't closed below it. So what I would like to see, which correlates with the other narratives here, would be to finish this downward push as we have marked out, to at least take out this consolidation, right? We only marked it to halfway of the actual gap for the week, but I expect this to close in, or I expect it to get to the lowest quadrant of this gap. what I had measured from before. So this breakdown of this dealing range, one standard below that, put us into the super discount of this gap below these, this winding, what looks like a weak low to me, and we do have this unpriced gap. So finishing off of this downward leg would mean clearing these lows, and it certainly looks like we're on our way. If we broke this and we have a 1, 2, 3 drives pattern, I would still like to see the 75% super discount of the parent dealing range hold, right? This is the parent dealing range, and I would like to see that hold from a body perspective. It doesn't have to on a 4-hour basis. Certainly on a daily basis, I would like to see that hold. 4 hours, it's still currently holding. We closed just maybe 3 cents below it, I think, and then shot up, and now we've come back down. So for oil this week, while this general narrative is still in play, I'm going to hide that for now. And then I think for oil, we see something like this to close in the gap, and then we're really off. Again, we were only really looking for longs on oil once we got below these lows, or at least into this gap, but we could see, if we're doing cross-market analysis, inverse correlation on other assets, that oil was very likely still coming to dig in here. So that's why I was not surprised to see indices, gold, silver, euro, and pound popping towards the end of the week last week, because once oil had rejected from this imbalance, and again, I wasn't going to sell it into this liquidity, even though, with the conviction there, I probably should have or could have. There were some nice wicks to get, if you were trying to short this down into this liquidity, there are some pretty big wicks to take you out, right? These are like $2 wicks. Yeah, $2 wicks. So that's a pretty big move on oil if you're not used to the contract sizing. But yeah, so I expect oil to finish off its distribution of liquidity here, and who knows how far into the rest of this imbalance we get. This did invert and it gapped up, so I don't fully expect the entire range here to get mitigated. It's possible we blow through this low. The continuous contract also still does, it looks like it's going to hold, so I would still expect that oil makes a run down below these bodies on the continuous contract, whereas on the July contract itself, it probably won't, and might leave this inverted fair value gap here above here intact. So that's what I'd love to see. I'd love to see it wick the discount low of this gap up and continue, or it might even have to consolidate in here for some 4-hour spells. But on a daily time frame, I would like to just see a wick down here and back above the 75%, or at least back above the consequent encroachment of that gap. So we would take the liquidity and fail to close below it, this candle here. So that's what I would like to see, that this down close candle, the upper half of it, the bodies over here will respect the midpoint of that candle, the mean threshold of that candle, where we wick the liquidity, and then we can take off to the upside. When we look at gold, right, we were still very bearish last week, and we had this nice cascade down to take this low, which was expected. And then we definitely reacted from there. By cross market analysis, we look at silver, and silver has not yet taken this low. So that is definitely a correlation crack where we could expect then more bullishness towards the end of the week, right? Where gold swept the low, silver did not, and we certainly saw a reaction there. Copper, by the same token, was quite strong. It actually did not break this low yet. But that's exactly what we were talking about with copper, where we had this trend line that we did break, right? We had this trend line that we broke, and now we've retested, and we look like, if people were saying, oh, it's a false breakout and we're going to go higher, I don't think so. We look where we ended up on this. This is the daily time frame. I'm going to go back to 4 hours. So we might still see some strength in copper at the beginning of this week here, but you can see we rejected straight from this, where we had this inverted fair value gap we rejected from that. We have still closed below it. If we just take the sell side of that gap, we actually just hit the mean threshold right there. And we have so far rejected. We're in the gap right now, below the lowest quadrant. So, between these two gaps, this sell side imbalance gap, we hit the mean threshold. And with this gap, we closed below the inversion fair value gap here. So while copper has still maintained its strength compared to gold and silver, I do see that gold and silver are still going to be dragging copper down with them, and silver is likely to take these flat highs with an imbalance. So if we look at some of our other videos on how to avoid bad trades, once gold swept and silver did not, we can certainly expect a return to premium here and clearing of these flat highs. So silver, we did have a bearish run. Once gold took its liquidity, that would have been a good time to exit if you weren't already exiting. If I'm playing silver, I'm still playing it short, and I'm waiting to clear these equal highs into this imbalance. We might even wick the bodies of this candle that displaced, so I could expect something all the way up to here, and then we can start to continue a run to the downside for silver. If we do take a dealing range here where we have some liquidity taken here to here, right? This candle, the super premium of this dealing range puts us just above this candle's body, right into the wick. So that would be the super premium that might get taken. I know we have these relative equal highs in a overarching premium, and again, we thought maybe it would be taking those 2 weeks ago and then we'd dump. Instead, we just dumped. And again, when this NFP candle came in, we closed below the 50% of the parent dealing range. So I don't expect this to get traipsed through. I don't want to see it come back up there. If we do, maybe we're starting to see a decoupling of risk on and risk off assets, and so that we'll just have to play those a bit more carefully. I don't see this low and this low as being held by silver, so for it to come completely back up here and take these relative equal highs before taking these relative equal lows, it doesn't make sense to me. If it does that, then we're ultra bearish to come back and rip out this liquidity, because the way gold and silver and where we're looking at the copper chart, I can't imagine that it's ready to decouple from the risk on assets yet. And I want to be looking for silver to take this double bottom. So gold will potentially also have a run up this week, maybe clear this high into this imbalance bottom of this range. So I could be looking at gold. There is a 50% back up here, so we could tap that, close in this imbalance. I wouldn't actually expect that to happen because of where it is in the parent dealing range. You want to see a gap, you want to see displacement through the 50, so I would just kind of expect to see this candle maybe get a wick, have that body liquidated, and then we can continue down for gold. So just a retest here in this, maybe this sell side imbalance somewhere in here. I'd be looking for my 1 hour time frame to displace downward and get in sync with a short. And it may happen as late as Wednesday, right? Because that's when the FOMC announcement is. So there might be a manipulation down to say, okay, we're continuing shorts, and then we go up, and then we come down. But my analysis generally is bearish. I'm only looking for shorts, so I'm going to be looking for gold, silver, copper to increase in price and maybe finish out this market maker buy model with a liquidation of some of these candles. Maybe that wick just gets taken, but I don't expect too much digging into where we displace through the 50% of the parent dealing range. Anyone that's been following along with this soybean story, I think this has been fun. So we definitely had this nice rundown last week. We consolidated a bit this past week, and now I still think when we measure this consolidation range, look at where one standard deviation falls from that. So this past week's dealing range, if we are to take one standard down, we go exactly to the trend line. We go, 3 ticks below the super discount here, 1, 2, 3, 4 maybe, and we hit, you know, the top of this inversion fair value gap from before. So to me, this just screams we're coming down here like we forecasted 3 to 4 weeks ago, and that will finish, hopefully finish this distribution. So for crude oil to liquidate the bodies of these candles, maybe liquidate the body of this candle and completely close in this gap with a wick, would completely align with the narrative on the soybeans, where they would finish coming down, tap the balanced price range just at super discount before we take a launch to the upside. So we did have the WASI report come out on the 11th, and that's a good catalyst to finish this consolidation, manipulate it down, and then hopefully, if our analysis is correct, we can take our longs on soybeans. Soybean oil, similar story. So we broke the trend line. This past week was pretty humdrum with 1, 2, 3 bullish candles on what I'm seeing as an order block. So we basically just tapped back into the super premium of this dealing range that we drew, and we rejected that. So now the trend line, if you're playing the trend line game, it becomes resistance, and we've certainly seen that. So we did react off the 50% of the smaller dealing range, but in line with oil going down, soybeans going down, the analysis would show that the soybean oil should come down to the super discount here, which doesn't quite get us into a discount of the overarching dealing range. And that may or may not be necessary, because that's all the way down here. So we could see this type of action, but this is what I was thinking. If soybeans had made a run all the way down to its low and then was going to take the highs again, then this seemed more of a plausible argument for soybean oil. Again, not completely correlated, so there's the possibility that these just move over this week, kind of like this, or, right, if we get a little more animated, we can come down, complete this dealing range, liquidate some here, get into discount of the parent dealing range. So we might see something where we come into this gap here, or even tap a 618 retracement of that. If we were to really run down to the super discount, that seems pretty far-fetched given where soybeans are, unless soybeans are going to completely run out that gap and liquidate the entire dealing range. Soybean oil, it still has these highs back here that I do suspect would get taken, right? We only cleared this high for now, but it's certainly possible that we are now starting to make a run down to capture a lot of this liquidity. So I don't see super discount of this parent dealing range, this overarching dealing range, as very logical at this point. So I do see liquidation of these lows as very likely, maybe just to the super discount and up with soybeans, or we could possibly wick through here, wick through the 50% and not close below it. So for soybean oil, I'm still looking for shorts mostly until we get to a super discount of this level, and then I want to see if we're displacing with a gap through the 75%, the lower discount of the higher dealing range here, then I would expect that we're pushing for the equilibrium of this range, this dealing range, and we could see the liquidation of this candle right at the 50% mark, right? So that is what I'm looking at on soybean oil. If we were to expect that this is a push of the 75% to the apex of a dealing range, then yeah, that's where we would line this up, and we still actually don't take out that high. So it's hard to say where this actually bottoms out, right? So with this dealing range, I could see this parent dealing range actually coming to, if we are to go liquidate the highs, then I look at this gap and this consolidation underneath it as the potential mark for the 50%. So if I am then to draw this as if that were the 50% of the dealing range, and we have, say, an explosive body close through it with a consolidation underneath it in discount, then, right, and even I have this one standard deviation of the current dealing range up to 93.65. if we zoom out, 93.65 does clear the all-time high back here. And if we were to run that dealing range up to say 92.57 or 93.65 as we outlined here, then when we look at that from a dealing range perspective, it does look a little high to me on this, where the 25% mark is kind of in no man's land. 75% mark we wouldn't have even hit yet. So I guess what I'm seeing here is that it's not quite going to one standard there, but if we draw the dealing range somewhere like this, where 25% falls within a gap and a launching point, 50% we consolidate just below it, and then we push through, right? And here we haven't even, with 618, we kind of consolidate and cluster around it. So yeah, this I don't think that this will happen this week. I think we would just push down into discount here, maybe tap the top of this consolidation, hit the super discount of this upper dealing range from this candle's low to where we are now, back on a daily, right? If we're able to get down to 69.10 area, definitely be looking for longs, and then we could try to push with soybeans all the way up to the highs here, and that might complete the dealing range. We could see a consolidation here and a rejection at the 75 super premium level, which we almost got to. So if we're to project the dealing range that way, and we look at this as a discount that we can return to make a nice displacement to the upside, correlating with a early weak dump in oil, and then a push with soybeans, soybean oil, all kind of following suit to come down to clear liquidity, or in this case come down to a discount and a super discount of the last 3 weeks, then it makes sense. The narrative would be to push to the all-time highs and clear this guy with ease. So I will be looking for soybean oil to come down. I'm not going to short soybeans and soybean oil into where I want to see their ultimate turnaround here to go bullish. Again, I'm also not shorting crude oil into that gap. At this point, we're so close to it, the risk to reward isn't there, and I'm ultimately looking for longs on all of these now. So when the price was right up here with all this liquidity, yes, shorting, and that you have the bulk of the range to get there. Now we only have this little piece, so that's not even a quarter of it. So don't be shorting this into this gap, even though that's what we expect to see. Expect to see it react from here. If it does, then that's exactly what we want to see, and we want to be longing it to here. We had this suspicious double top that we thought would get taken after we ran all this sell side liquidity into a super discount, into a gap. Soybean oil, again, we had that really aggressive trend line, and I think we just are teetering on the bottom of it. We've displaced, if you're really aggressive, because there is still half of this move possibly here into discount of what we project as the parent dealing range, go ahead and be my guest and try to short this down to 69.83 or 69.70, just $70 might make sense, right? That could be a legitimate short. Your risk to reward is not outlandish here. If you're to put a short position on, I think you're actually fine. So let's say we retrace just to get Friday's high. Your stop can go above this fair value gap if you are really conservative, and your target is 70, right? 1.67 risk to reward. You could probably squeeze in 2 trades where you protect your position with this candle, and now you've got a 3.66R trade. So you could take 2 bullets on that for the price of 1 with a risk above this inversion fair value gap. So that may be something to consider. If Monday we push up, take Friday's high, and then we want to dump down here, I would look at that. So that to me has enough risk to reward where that makes sense. On the soybeans, it does not make sense, because I actually don't know. I see this as a weekly dealing range that won't get wicked to the upside, and I think we just tap into the middle of it and come down on soybeans next week. That would be my projection. That we did already actually double top at and above the 50%. So soybeans potentially just have a little run up to wick that body, and then we come down. But again, this risk to reward for me is not particularly enticing. If I were to short one, it would be the soybean oil. At least it has some more room to run to clear out a lot of these sell stops here, and then possibly look to long it. Okay, on the indices, ES, we had a lot of arrows drawn last week for potential scenarios, right? Because of the imbalance that we left with NFP, there were actually, in my perspective, quite a lot of things that could happen, right? We could have gapped down and ran, which when you look at the situation and the news coming out, that didn't quite make sense. So we thought we might see a retracement and then a dump, and we did see that, right? So this situation where we retraced and we got just barely into premium of the down leg here, and then we did have a nice run for maybe one standard deviation down from the run up to the run down, and then we definitely reversed and took some of the good news on Thursday and Friday to have a bit more of a bullish reaction here. So that's not unexpected. Again, where crude oil was trading, and with the inverse correlation with these guys, once we kind of made this low on Wednesday and oil had not made a deep enough run into its gap that I want to see, I did not expect these to continue downward for the week. So, this run up and this run down was kind of the play for the whole week. And if you were aggressive, you could have started to look for longs in this area on Wednesday. As we turn around, we break this high, and then we come back and dig into, I'm sure there's a gap here on a 1 hour time frame, and explode higher. We could just explore that really fast. Yep, there it is. Right? So when we look at this 1 hour time frame, if you were paying attention to where oil was and what was going on here, this 1 hour fair value gap, what happened? Touched exactly the discount low of it, and we start to explode. So once we traded above this high, barely, right? It's like a tick above this high, and we see some equal lows, and we have an imbalance with another volume imbalance here. This is not unexpected. We see it tap the discount low of this 1 hour fair value gap to the upside, where oil was, where NQ and YM were. This double bottom, sure, it's left for now, and I expect it to get taken in the next week or two, but we'll see more of that in the analysis. But this 1 hour time frame was fairly clear that something like this was going to happen, and I was telling my wife on Thursday at 1:20 p.m. on Thursday, I was short, wanting to just do a very quick scalp into these bodies, and I was going to refill my tea, and I didn't think in the 2 minutes I was gone that this was going to happen and completely stop me out at break even, but it did. So that's, I had 5 accounts going with a short here. I closed 2 of them, left 3 at break even, and came back to stop outs with some slippage. So I did lose a bit on those 3, but I had gained enough on the 2 to kind of make up for it. But right at 120, I was looking at the chart thinking, man, there's something's going to happen here. Someone's going to tweet something, and lo and behold, there it was. So you could have been looking for longs after, I was actually looking for longs after 130, and it happened just before 130. So I hadn't closed everything out yet. My suspicions were correct, and we ended up blasting up. So I should have been a bit more careful there, but I had caught them from up here where we had wicked this body. So I wasn't terribly concerned with a stop out there, but it was unfortunate. However, the analysis, once you left this gap and we came back into it, I really should not have been trying to squeeze as much out of those shorts as I was. But that's trading. So I wanted to look for longs after 130, and by that time it was already up here, and I was not looking for longs up here. So there we have it. So I erased a lot of those arrows on ES for the time being, and we did take a good bit of liquidity here below this double bottom and the NFP candle. What I'm seeing now, right, we have closed, if we measure the dealing range from high to new low here, we have closed basically at 50%, right? And if we expect, say, oil, say, soybeans, etc., to make those runs down, and gold, silver to make a run higher, I would also, and euro and pound, I would also expect that ES, NASDAQ, and the Dow make some kind of run higher, right? If there is, as I just read on Forex Factory, that deal might be signed within 24 hours. I mean, who knows what's in the deal, right? But that may cause a nice gap up. And again, last week I was lamenting ES leaving this flat double top up here. I still don't see it as out of the question right now that our target dealing range top of 77.10 doesn't get in play, right? So we can make a run to 77.10. Everyone's like, ooh, buy SpaceX. You know, that's, I think, now even included in the S&P 500 and NASDAQ. So everyone is being exit liquidity for all the insiders on SpaceX and the early investors, right? To have this nice run up here to clear out everyone that was short before NFP and complete this dealing range to have a nice spike double top. I'd love to see a wick up here and back down on Wednesday, FOMC, where we have a rate announcement. So when we say it's going to be priced in, I actually expect a bullish run up to about here by Tuesday, Wednesday. And Wednesday, we can see a daily wick through this nice flat double top that I wanted to see taken out. Maybe it's this week that it gets taken out, where we come up here, we wick through it on Wednesday, and we close back down, and then Thursday, Friday can distribute to the downside and kind of complete this breakdown, a liquidation of the breakdown, and complete. So I would, again, as I did not think ES was done with this double top, and it's looking like it's going to have a nice market maker buy model to clear it out at midweek, and then hopefully we really are looking for shorts for the rest of the summer. So while I was looking for shorts this week, I caught some good ones. I was not really looking for longs until Thursday when I had that suspicion here. So I'm not going to long this again up to the top, but I do want to see, I want to see Monday and Tuesday be manipulating this guy higher and take out the high on Wednesday at the FOMC. That's my narrative for the week. If it doesn't play out, we'll adapt and adjust, right? I mean, there's possibility that we just get up into this gap and we can short. This could be the long-term high. But again, where we projected the dealing range, this 25% mark, we shot below it, we closed back above it. It was the launching point. It can again still be the launching point to the apex of 77.10, which is where I wanted to see it. So that said, we will monitor ES and NQ and YM this week and see exactly what happens. But to me, this does look like we could be having a market maker buy model to clear out these highs before we go. NQ may not make it that high. YM looks like it probably will, but it also might not, right? So when we look at NQ has closed back above the 50% mark, so we did come up right into the 50% of that imbalance, and we flushed below these lows, and then we reacted. So right now, the dealing range here, we're back above 50% with a nice close. We had a bullish close through the super discount. So on this smaller dealing range, right, we are looking like NASDAQ could also come clear these highs. And again, NASDAQ hadn't reached our full target of 30,858, I believe we had from 2 weeks ago, or 30,852. So while NASDAQ looks certainly bullish here, we could also see a wick up to take out this high again. And I honestly thought we weren't done on NASDAQ either, even though this was a great bearish candle. That's the first indication that we could be headed for some shorts longer term. But it's not surprising to me to see a liquidation of the candle that started the event to get run out by, taking this high, taking the wick, taking the body of this candle. Maybe we fail swing. I doubt it. I think NASDAQ would come take it, and then we come down. So NASDAQ, I see NASDAQ for the week coming up and then down, maybe Wednesday, Thursday, we'll see where NASDAQ goes. I'd like to see it get up to 30,852, where we had outlined the entire 4 standard dealing range, and take this high one more time and come down. So that's what I'm forecasting on NASDAQ. If it wants to stay weak and stay down here and then break down, again, that's fine. I'll be looking for any 1 hour displacements with an inversion fair value gap perhaps for that to continue to the downside. But again, we've matched this high here right now, and I think we kind of already matched it here. So when we took this liquidity and came back up, now I see this as in play before we actually form a double top, where this broke a double bottom, it broke into a fair value gap over here, and we could certainly liquidate this first high, and we get a second high for a breaker on a longer term weekly, almost monthly basis, where this would then become the ultimate high for Q2, and we end up Q3 distributing downward. So that's where I'm seeing NASDAQ. YM has potentially the greatest chance to fail swing here. So, you know, it's not going to correlate. It has sometimes been negatively correlated with ES and NQ, where, you know, Dow will just take a huge dump while ES and NASDAQ are actually maintaining price or increasing. So Dow's shown a bit more of a negative correlation with those two assets most recently than, you know, in a lot of recent history, where the indices all kind of do move together. But you know, right now for Dow, we had this dealing range before, and if we are to take a new dealing range to the bottom here, then we have certainly pierced the 75%, the super premium level, and closed back below it. So if ES and NQ are going to make a run up, I would still expect Dow to make a run up and probably clear this high. And all three indices could make a nice breaker that way. So a high, low, higher high, and then a breakdown. So that's still what I'm looking for long term on all the indices. I do think, say, SpaceX, OpenAI's IPOs are exactly the liquidity exit points for insiders and the ultra wealthy to just eke that little extra bit out of the retail crowd that want to get in at the last possible second, you know, and basically pay everyone off on those IPOs. So Dow, it wouldn't surprise me if Dow peaks and comes down again too. My disclaimer on the indices is that sure, they can always go up, and this is my more doom and gloom scenario. And I do think that everything's just supremely overpriced, and this matches the narrative with gold and silver still plummeting to take out their lows. It matches the narrative with oil coming down. It matches the narrative with a probable and potential peace deal, and who knows what else comes along as an event or a news catalyst after that. But all the narrative pieces still align for this to complete on the ES and NQ, complete their dealing ranges as we had projected them before. And for YM, who had already done this buy model here, to then take liquidity, break down, and probably chop around and maybe with FOMC wick this high. If it doesn't, and if it happens to failure swing and just wicks the bodies here for some reason, then again, that's another ultra bearish signal where it can't make a new high. This was a new high on the Dow where ES and NQ didn't make a new high. So if YM now fails and comes down and ES and NASDAQ make their new high to form the breaker, ultra bearish on the indices, then all of them. So that's the narrative there. Bitcoin pretty much chopped around after wicking this low last week. So I do expect still a bit more of a retracement higher into the bottom of this range here. So that narrative is still pretty much in play. It really didn't do much last week. 5 days of 3 down, 2 up, or 2 down, 2.5 up, and it just is consolidating here in the discount of this dealing range where we wicked the low at 60,000, and we're just consolidating here. So I want to see still a move up here to the bottom of this range that really started the run to liquidate prior consolidation. I want to see a retracement into some portion of this leg before we would actually come down. So if Bitcoin is to correlate a bit with the risk on assets, yeah, I would expect to see some rise as we forecasted last week. It just didn't do much in that regard. And since Bitcoin's pretty heavy, I do think we don't get too far into a premium market here. This does look like a repricing candle, i.e. no wick on the top. So in an ultra bullish case for the week, we could come up and kind of wick that liquidity and then be coming down. So in any case, I'm looking for shorts on Bitcoin. I'll want to see a 1 hour or 4 hour displacement here on some kind of format to get in sync with bearish order flow on this guy. So while we wicked the low here, that to me is not bullish. We just are going to take some of this rebalancing to then dump lower, as we have looked at on the weekly time frame for a while. So Bitcoin is still targeting these lows down here at below 49,960, the super discount of the parent dealing range, and possibly farther 25,000. Again, on the longer term Bitcoin narrative by say October, we could be down here, and that's still the ongoing narrative on Bitcoin. So that does it for this week. I do think crude oil is really telling the entire narrative of the market at this point, and until we can take some new lows, I still think we're going to be bullish, not to necessarily take longs, but I do think we're going to see continued bullish action on most of the risk on assets: gold, silver, copper, indices, Bitcoin, euro, pound, until and if we see complete closure of that gap on oil and a reversal from there. Now, that said, we could continue to see bearishness on the oil if developments continue in the Middle East on a peaceful side of things. So that could completely confound the overarching narrative that we've drawn this week, but we got to stay nimble, stay adaptable, and take a look at what's happening during the markets, especially after FOMC drops on Wednesday. So stay tuned, and we'll catch up later in the week. If you find our analyses helpful, please like and subscribe, and we'll definitely keep doing these. Also, let us know if there are other assets that you want us to specifically look at, and we'll be happy to include those in our analysis. Cheers, good trading, stay safe.